Good afternoon, everybody. It's Jed Joling with eXp Realty here, and I've got a Southern Oregon market update for today, Monday, March 13th. We've got a lot to cover. There's a lot of things that happened over the last few days, and we've also got some data from last month, and we're going to jump right into this last week and what today is looking like. So right now we have 812 active single-family listings between Jackson and Josephine counties. That number's up 24% from last year today, where we are sitting at about 616. This last week we had 90 new listings hit the market, 86 went pending, 65 closed, and 19 off the market due to expired or canceled listing contracts. Out of that 90 new listings, 18 of those are already pending, and that's 20%. So 20% of the inventory that came on last week as new listings have already gone pending. So that's getting to be somewhat of an impressive number in the market we're in. A 4-week average right now, we are up 6.5 on the new listings. We are up just a half on the pending listings, and we're up almost 10 on the closed listings. So per the 4-week average, we're looking good. Numbers are growing on this week compared to our 4-week average. Now, if we look at those numbers for this past week compared to last year, this same week, we're not looking nearly as strong, but we've known that. We're down 38% on the new listings for the week, 41% down on the pending listings, and down 38% also on the closed listings. Looking at a snapshot of this week's inventory, it puts us at 2.9 months of inventory on the market. So theoretically, if all new listings were to stop today, for what we currently have on the market at the rate we were closing homes this last week, we would last 2.9 months till we ran out of homes to sell. Looking at the 4-week average snapshot, that puts us at 3.3 months of inventory. So really not much more than the single week snapshot there. Looking over to mortgage rates saw an adjustment over this last week. A week ago, we were at 6.99% on a 30-year conventional fixed mortgage, and now we're at 6.57%. We're going to explain what made the sudden change. On an FHA 30-year fixed, we are at 6.1%. Projected inflation for the inflation report coming out tomorrow is looking like it's going to be right around 6%. Unfortunately, we don't have that number yet, so we'll have it next week, of course. Our year-over-year sold volume, we didn't have these stats in last week, but our year-over-year sold volume for Jackson County was down 51.1%, meaning the total number of dollars sold in real estate for single family was down over 50%. And for Josephine County, it was down 35.6%, so not nearly as much. We saw it affect Jackson County a lot more. So now getting into some of the bigger news that you've probably already heard about over the weekend, or maybe before the weekend even. But there was a major issue with the bank this last week, and it caused the FDIC to come in, the federal regulators, and take it over. So if you haven't heard, the Silicon Valley Bank, it's a bank down in Silicon Valley, a lot of startups, a lot of tech companies bank there. And I'll kind of give you the backstory, the history here. So 2019, Silicon Valley Bank has about $60 billion in deposits. And then COVID hits, tech goes crazy, everything goes crazy. And now, end of 2022, they have nearly $185 billion in deposits. So what did they end up doing with a lot of that extra money? What they did was they went and they kept some of it, of course, and kept it liquid or cash on balance. But they took the rest of it and they went and they bought long-term treasury bonds at a rate yielding around 2%, give or take, depending on when they bought those bonds. So thinking, that's, they're going to get their money, it's going to grow over time. Good deal. So I'm going to follow my notes a little more closely now because I've written this out. So they invested their majority of their deposits into the treasury bonds, yielding around 2%. Customers started withdrawing funds, and so Silicon Valley Bank needed to sell some of their long-term treasury bonds to gain some liquidity back to keep up with those withdrawals. But selling a bond that's paying around 2%, that when you can currently go buy a bond that's yielding about 4%, proves to be a bit difficult. And in basically what happens, that bond is worth a lot less now than it was when they bought it. So they take a loss. They assumed a loss of about $2 billion, if I'm correct, per what they were saying. And they had to announce that. They're a publicly traded company in the stock market. They announced that they were working on a plan to fix the issue. Well, in the meantime, word gets around, and word travels fast this day and age. And what happens is all the depositors start going to the bank and taking their money out because they're worried, well, what's going to happen if they can't make up this loss? So what happens is called a run on the bank, and essentially all the depositors start pulling money quicker than the bank can keep up with it. This resulted in them having almost a negative $1 billion balance. So the FDIC had to come in, and they came in late last week, and they ended up taking over the bank. The SEC paused trading on the stock. The stock had gone from $280 a share last week to $39 a share at the end of the week when they halted it. Now, what's interesting, and this issue sounds like it's going to be resolved for the depositors, but each depositor is only guaranteed insurance on $250,000 of their money in that bank. Over 97% of the money in that bank was not FDIC insured for that $250,000. So essentially, you're not guaranteed to have that money back. And so this obviously freaked out probably every business that banked there that had more than $250,000. But Sunday, the Fed announces, well, we're going to come in and we're going to, they came in earlier, but they're going to come in and they're going to guarantee between them and the Federal Reserve that everyone will get every last dollar they had in that bank. Don't worry. Because obviously things like this can cause a massive financial scare that can go through the market in a wave effect, ripple effect, and it still likely will in ways. We saw stock markets respond a lot better today than would have been assumed before that announcement yesterday. I was up late last night. I saw the stock futures at about midnight, and they were looking good. And I'm not sure what we closed at today. It's right around 1 o'clock now. But I'm sure we were going to close a lot worse if they hadn't made an announcement like this, that they're basically bailing out the bank. So this reassured the stock market. Following the failure of Silicon Valley Bank, though, yesterday there was another federal shutdown of a bank called Signature Bank. I believe it's out of New York. And it's a heavily crypto-focused bank. And so for whatever reason, they saw deemed fit to come in there and shut that one down as well. But more than likely, we're going to see probably a larger bank come along and either buy up these banks or work out a deal. But big news. So how did that affect our interest rates? Well, at the end of last week, our interest rates were 7%, and then Friday they came down a little bit. Today they came down more. So from Thursday to now, they've come down almost 0.5%, which is great. And likely the Fed is going to be attacking things a little differently when it comes to their rate hikes, and we probably won't be seeing, we may not be seeing any more rate hikes this year. We'll see. We might even see some decrease in the Fed funds rate by the end of the year, which is going to help with the mortgage rates. So that could be good news for buyers. But that's all I've got for now. I'm signing out. I'm actually down in Las Vegas this week for a convention. So I came out here by the pool to take the time to do this, but wanted to keep you guys filled in on what's going on with our market and nationally with that big news. So I hope everyone has a great week. We'll talk to you soon. Bye-bye.